To borrow or not to borrow? That is the debt question. Today, we're looking into debt ratios. Fellow investors, bonjour. This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement. Dividend investors, bonjour. Mike Leroux here. You're listening to the Dividend Guy podcast. And today we have a more technical than usual podcast. It's going to be a lot of fun. And for that, I have my co-host Véro that is with me. So Véro, did you enjoy working with the math from this one?
Well, Mike, you know me. I will let you digest the math here, but I had some fun preparing the questions because I truly believe that it will benefit our listeners. Like, since we are in a never-ending bull market, you have repeatedly said that this is not a time to take too many guesses and to invest in quality companies. And with quality, I mean, one thing to not underestimate is debt. So many companies rely on it to grow, but how can we ensure that it will not destroy them? This is what we will discuss today. So, Mike, before we analyze the debt metrics and ratios, please explain why investors should not fear debt. Like, in other words, what are its main advantages?
Well, of course, when you think about debt for a business, you have to think about the leverage effect. So there are a lot of ways to use leverage when you run a business. You can leverage the human resources that you have, you can leverage your time, but you can also just make bigger projects with others people's money. We often hear about that as like, well, there's no better way to build a business than to use the bank's money instead of your own. You have a lot
Mhm.
more, and then it helps you to explode and increase everything that you're doing. Even at Dividend Stocks Rock, this is exactly what we did for a while, where we had large project to revamp our website a few years ago, build the stock screener, have like the DSR portfolio dashboard. Well, of course, all of that would have not have been possible if I had not given a call to my banker and say, "Hey, we have a lot of projects right now, so maybe you can give me a help." Because trying to do everything cash, I mean, it's like if you want to buy a home, right? If you don't want to have a mortgage on day one, well, you will have to work several years and it will be virtually impossible to buy a house in your 20s, probably not even in your 30s. And then by the time that you're
Mhm.
in your 40s, the house price has been going up so high that it's probably not even going to be possible.
Mhm.
So, long story short, the debt could be used as a shortcut for growth. And the opposite is also true. A lot of companies that have virtually no debt or very little, sometimes they also struggle to generate the same amount of growth that other companies that are willing to take additional risk are, usually because they do not benefit from that leverage effect.
Mm. Mhm. Now, investors can find credit ratings online. What are they and should we use them?
Yeah, those are very popular. We have like three major credit agencies. So you have S&P Global, you have Moody's, and you have Fitch Ratings. They usually classify companies with their ratings in a similar manner. So you can just go for one of them or look at like the three credit ratings. The idea behind giving a rating, as Fitch explains on their website, is to publish a credit rating that are forward looking opinions on the relative ability of an entity or an obligation to meet financial commitments. In other words, it's the perception that we have when we look at a business is, are they going to be able to pay up their debt or not?
Mhm. Mhm.
So Fitch continues by saying credit ratings are indications of the likelihood of repayment in accordance with terms of the issuance. So what they do is they mostly look at the company's balance sheet, they look at the perspective, and then they're trying to determine what is the likelihood of those bankers getting paid off at the end of those terms. Not all companies have credit ratings. We usually see those being reviewed by major credit agencies when you have a large business. So sometimes if you look at small caps, for example, it's going to be harder to get this kind of information.
Mm-hmm.
And if you're just want to go for, I would say maybe like safer companies, you can go with what we called investment grade. So companies that have a rating of triple B, so BBB and or higher. So it's a little bit like going back to school when you look at those ratings.
And what does it mean when a credit ratings changes?
Well, like any rating, you have to take that with a grain of salt, and you also have to put context around it. I mean, it's good for our DSR ratings. We have a pro rating and a dividend safety score, but it's also good for any credit rating. Of course, the credit rating of S&P Global has a little bit more impact on the market than the DSR ratings, I would say. So whenever it changes, it could have an impact on the stock price, but it will also have an impact for the future of this business. Imagine that there is a credit downgrade. Well, it tells that a lot of like banks will say, okay, we're going to issue more bonds for you guys, but now it's going to be more expensive. So it's all about the perception, but of course, when there is a credit rating change, the agencies will also provide explanation to just mention what's happening around the business and why they have decided to like either move it up or move it down.
Hmm.
Later on this show, we're going to talk about two companies and their credit ratings and how like they evolve using debt. One of them, we decided to pick BCE in fall of 2024. Yeah, big surprise, right? But I mean, it's going to be interesting to look at the ratios and everything,
Right.
though. Back in fall of 2024, BCE saw one of the credit agencies to downgrade its rating. So the impact was not just the stock price moving, but also telling investors, well, in the future, when BCE will come to issue new debt, it's obviously going to be at a higher interest rate than it used to because credit agencies kind of said, well, we don't trust this company or we trust it less. So it's not like
Mm.
a junk bond or anything, but it's just that, yeah, the likelihood of repaying the debt has been downgraded by one notch. So just be careful. So I would see that more like as a red flag. Again, even those big companies could be wrong on the rating. So you have to be careful. And I thought of like giving a few examples of like great companies with great ratings.
Mhm.
So, for example, like a company like Microsoft will benefit from the highest level of credit rating, like a triple A. So, like showing like everything that is great for this company. And kind of ironically, it's not really a company like Microsoft that will need debt. So it's literally like when you look at personal finance, if you are struggling to pay your credit cards, well, it's probably the bad timing to go see your bank and to see your banker to get another loan. They're gonna look at your profile and say, well, you're already well in debt. You cannot make your payment. You will have a bad credit rating, and this is when they will not lend to you. On the other
Mhm.
side, if you have no debt and you're making $500,000 in salary per year and you have like a government job, well, it's super secure. Well, banks are going to say, yeah, I'm going to extend to you a huge line of credit, unsecured, and it's all going to be great. So
Mhm.
it also reflects the same way for companies. So if you're worried about the company that you have in your portfolio, then you can take a look at those credit ratings. It's going to give you a good example. So for a company that is doing good but has like a stable credit rating, but it's not stellar. You can think of like companies like Enbridge or British American Tobacco that will be rated around like a triple B or triple B plus. Those are like companies that are, yes, doing well. They're going to pay their debt, but they have weaker ratings than a company like Microsoft or Johnson Johnson that benefits from like triple A ratings.
Mhm. Okay, so let's move to the debt ratios. What are the most popular ones and how do they differ?
So you have two type of debt ratios, and listeners, you probably want to bookmark this episode or like make sure that you can hit pause and take like a paper and a paper and a pen or something to write down notes because we are going to run into a few metrics, a few explanation, and it's going to be a little bit tougher to follow if you're not sitting at your desk. But anyway, here we go. So you have two types of ratios. You have liquidity ratios and you have solvency or leverage ratio. So we're going to talk with liquidity ratios that will measure if a company is able to keep doing business short term. So we're really like looking at if the business has the ability, has enough cash to meet up all their responsibilities, like to pay up their debt and ongoing expenses
Hmm.
without raising external capital. So without getting into more debt or issuing more shares, because a company can use like those two leverage to get more money. So either they will issue more shares. We see that often. For example, like National Bank will pay in shares their acquisition of Canadian Western Bank. So they will likely issue more shares to do that. Or they could also call their banker and say, hey, we're going to issue more debt. So issuing bonds on the stock market. So the first ratio we're going to look at is the current ratio. So the current ratio is current assets and on current liabilities. So in other words, do you have short-term assets to cover short-term liabilities for the quarter? You hopefully you have something that is above one, telling you that your short-term assets such as like cash and cash or equivalent are enough to pay off like short-term liabilities. The next ratio is the quick ratio, often called the acid test. So this one is really, do you have enough cash or cash equivalent? So we're really talking about like everything that is liquid and 100% sure to pay your bill at the end of the month. So this one is the current assets minus the inventory. So the inventory is not sold. So even though you have 5,000 iPhones in your stores, well, if
Mm.
you don't sell them, chances are you're not going to have enough money to pay your rent at the end of the month. So
Right.
current assets minus inventory divided by the current liability. So you're getting a little bit more precise than the current ratio because you're taking off the inventory. The next one is the cash ratio. So this one is more straightforward. We're really talking about just cash, but it's limiting because sometimes more money will come in, but you don't see it in this type of ratio. So on this one, it's really just cash and short-term equivalent divided by current liabilities. So for all those ratios, you want them to be above one, of course, because by having them above one, it tells you that you have enough cash or you have enough short term assets to pay your short term responsibilities. Uh, for an example, if you look at BCE, cash ratios, they're all under one for the three of those
Mm.
I just discussed. So and you probably heard that either on my YouTube channel or either on the Moose on the Loose or either on this podcast. But I've been quite vocal about BCE struggling with their cash flow situation in 2024. It's been ongoing for a while now. And if you go a little bit deeper into the financial statements and you run the ratios, you discover exactly the same thing. It's just confirming what has been explained as a more global analysis, but then you have like real numbers for very like for specific metrics that are also telling you that Bell is struggling with its cash flow. Moving on to the second set of metric, we have the leverage or the solvency ratios. So that is those are telling you how solid the balance sheet is, but it's also telling you a little bit more context on what the company does to finance their projects. So, are they issuing more shares? Are they getting more debt? How they finance their business activities. So, the first one is the debt ratio, or also called debt to asset ratio. So you want this ratio to be below one because you want to have more assets than more debt. So if you look
Hmm.
at long term debt plus the current portion of the long term debt, so basically everything that is long term, divided by the total assets. So it's telling you if the company has more debt than assets, basically. So if it's below one, it's a good sign. As an indicator, BCE shows a debt ratio of about 0.56. So, in other words, they have about twice the number of assets than they have in terms of debt, which kind of makes sense because it is a capital intensive business, but Bell does have a lot of high quality assets as well. So
Right.
it's normal to run on debt and to grow their business. So in terms of that for the balance sheet, that's not a problem. And again, we mentioned that the company had cash flow issues, but not necessarily like the balance sheet is not ultra weak for that reason. The second ratio for the solvency ratios is the debt to equity ratio. This one is not good or bad, but rather tells you if the company requires more debt or more shares, so more equity to finance their project. So the calculation is quite simple. It's the total liabilities divided by the total shareholder equity. In other words, you look at if the company is using more debt or issuing more shares whenever they have to invest and raise capital. So
Mm-hmm.
the I debt to equity ratio just tell you that they use more debt, and a low ratio will tell you that they go more for issuing shares. For the example, BCE has a 2.3 ratio, so they issue a lot more debt than they issuing shares to finance their project.
Mm-hmm.
Finally, you have the financial debt to EBITDA. So, financial debt size compared to earnings before interest, taxes, depreciation, and amortization. So, literally, financial debt divided by the EBITDA. Again, you would like to have a like kind of like it's normal to have a ratio above one because the company is likely going to borrow more money than it can pay within a year. So you don't expect the company like making enough profit in a single year to pay all its debt.
Mm-hmm.
The ratio at this point is near five. So they have five times the number, like the amount of debt than they generate EBITDA, which is a bit high, but for this one is more important to look at the variation throughout time. So if you see that the ratio keeps on increasing, that will tell you that they either getting more debt or they're making less EBITDA. In both cases, it's pretty bad. So you would like to have something that is either stable, meaning that if debt is increasing and EBITDA is increasing, well, it makes sense because you're borrowing to make money. So you have something stable, it's great. If it's decreasing, it's even better because it tells you that the EBITDA is growing faster than the debt. But if
Mm-hmm.
it's the opposite, well, then it tells you that the debt is growing faster than the EBITDA. So, in other words, you're borrowing faster than you're making profit. You probably don't want that over a long term period of time either.
Right. Okay, Mike, that's a lot of ratios. I'm gonna let you take a sip of water. I think
Thanks,
that you
appreciate
spent
that.
like I think you spent like 10 minutes talking about ratios. So let's summarize this a bit and let me know which ones do you use and why?
I would say it depends on the question you ask yourself when you analyze a company. I don't systematically use all those ratios because that
Mm-hmm.
would just like pile up a long list of numbers, as I just did on the show, actually. So you can see how heavy it could become if you start analyzing every single metric. Some people do that. I'm not this type of investor. Instead, what I do is I look at the global analysis first. So already you know that if you have been a listener on the show, but I will start to focus on a strong dividend triangle. So for a company,
Mm-hmm.
the dividend triangle is a combination of three metrics. So I look at the trend for revenue, earnings per share, and dividend. When you have a company that is increasing their revenue, increasing their profit, and increasing their dividend, usually you don't have to worry too much about the debt ratios because when you look into those, well, they show that they are pretty solid. If you look at BCE dividend triangle, for example, well, you'll notice that the revenues aren't that growing that fast. Earnings per share are getting hurt, and the dividend has slowed down big time. So
Mm-hmm.
then it's a good reason to start digging a little bit more. Because, of course, the dividend triangle doesn't cover all angles and doesn't tell you everything, but it's a pretty good start to raise red flags. So at this point, I would go into the financial analysis and ask myself, okay, so what's going on with Bell? And while the dividend triangle was weak, by looking at specific ratios, I would see that Bell as still has a good balance sheet, a little bit geared towards a higher level of debt than appreciated. But the real problem is all the liquidity ratios, that the three of those are showing that it's under one. So telling myself, well, it's kind of obvious that the company keeps on borrowing more debt quarter after quarter to finance their projects, because without debt, they are not able to pay for their short-term obligation, so yet alone their long-term obligation as well. So the
Mhm.
ratios are used to confirm your hypothesis, to add the clarity, and then it's great when you tell yourself a story about a stock, the narrative, your investment thesis. So all the good reasons to buy or all the good reasons to sell, when you can use facts such as ratios, which is great, because I mean the ratio is the ratio, it's a number. You can do
Right.
whatever you want, the number is not changing. While using facts to back up your stories will help you in your analysis.
Okay, so before we move to our two examples, one last question. How does a high level of debt affect the dividend?
Well, there is kind of like a chain of reaction, right? So if you
Hmm.
have a high level of debt, well, you're going to pay more interest charges. And if you pay more interest charges, you have also chances to have a worse credit rating. And a worse credit rating will eventually mean that you're going to pay more for future debt. So then it's going to weight even more on your balance sheet and on your cash flow. So high level of debt means higher interest charges, means probably chances of having a weaker credit rating, means that if you need more money down the road, you're going to pay even more. This is not the kind of domino effect that you want, of course. And if
Hmm.
you're thinking of the dividend payment from the corporation perspective, it's just another payment in their books, right? So they have to make payments for on interest on the bonds that they have, and they also have to make payments on the dividend that they pay to shareholders. The big difference between the shareholders and the bond holders is the shareholders cannot really cry, and they don't really have any recourses if you stop paying the dividend. They're not going to be happy, but that's going to be the end of it. While if you
Right.
stop paying the interest on your bonds, you're going to have a whole new different set of problems. So you can imagine that the corporation, if the business is struggling, they will likely continue to pay their debt, but they will forget about the dividend, or they will cut it off
Hmm.
by a good portion, just to liberate some liquidity and make sure that they can sustain the business model moving forward.
All right, so to illustrate our thoughts, we will share two examples, one with a bad debt situation, and I think that you already know which one it is,
Big
and
surprise
one
here.
and one using debt correctly. So let's start with a now sadly famous company, BCE. Going back a bit in time, BCE has a long history of using debt. What makes it dependent on debt?
So, and just to be clear here, we're not trying to kill the company, and
Hmm.
we just want to illustrate how numbers can help you analyze a stock. So at first, when you look at BCE, maybe like 5, 10 years ago, you would still see the same company in terms of business model. It's highly capital intensive. Telcos require a lot of money, because they need to maintain and improve their wireless and their wireline uh, infrastructure. We have a very large country, so they need to spend a lot of money for that. And then over the
Hmm.
past 10 years, they have worked intensively to extend the network to the 5G technology, which required even more money. So it's kind of like a normal situation for telcos. I mean, if you would have looked at pipelines, it would have been the same. If
Right.
pipelines wants to be profitable and offer a great service to their clients, they need to invest into maintain and expand their network of pipelines, and that is quite expensive. So it made total sense for them to invest that kind of money, to borrow money, in the future. And that was the promise that all the techos kind of like made to their shareholders when debt was cheap, was we're going to borrow a lot of money, we're going to invest that into new technologies, and then we're going to generate a lot more cash flow from our clients because they will pay a higher bill. And then it's just going to create kind of like a free cash flow printing machine. And
Mm-hmm.
that's the entire idea of behind getting into debt. Is that calculation, that projection you make is, I borrow a billion today to generate free cash flow of like hundreds of $1 million every year for several years down the road. Unfortunately, this is not exactly how it always happens and how the story ends.
So, when did you start noticing BCE was taking on too much debt and why?
So the first signs were actually a weaker dividend triangle. So over the past few years, we have seen that the revenues were not growing that fast. The earnings per share were getting hurt. So when the earnings are going down and the revenues are stagnating, there's a sign of a problem. That's a red flag. So then you
Mm-hmm.
look at the financial statements. You notice then in the financial statements that interest charges keeps on increasing and fast. You look at the balance sheet and you look at the debt that is also growing fast. So more debt, more interest charges. When you renew your debt now, interest charges even more. So this is where you start to see that there's a problem that is building. Then you look at the cash flow statement and you realize that the free cash flow does not cover the dividend. So the free cash flow does not cover all the operation, meaning that every year the company must borrow money to finance their capital intensive activities and to pay the dividend. It's normal to see that for capital intensive companies. That will happen from time to time for like a few years when they have like massive projects. It is normal, but eventually it's not sustainable. It's
Mm-hmm.
impossible for anyone or any corporation to spend more than they earn year over year. You can do that as a person, as an individual for a while, but eventually you're going to have maxed out credit cards. You won't be able to remortgage your house, and then you're going to face bad decisions. Well, it's exactly the same thing for a business. And fortunately, for a business like this, they have like other ways like cutting the dividend. But this is what we are looking at this point, is the debt keeps on growing. The company is not able to generate enough cash flow to cover the debt and cover the dividend. And this is why all ratios looks bad today.
So, in other words, the debt ratio should not be isolated but analyzed along with other ratios, such as, like you said, cash flow and others.
Yeah, definitely. The any ratios that you look at, even like today we talk about that ratios, but any other ratios needs to be put in context first. If you look at the
Mhm.
PE ratio, it doesn't tell you much. If you compare the PE ratio through the industry, it's going to tell you a little bit more. If you compare the PE ratio of a company versus the industry versus the average of the past 5 and 10 years, now you're getting even more colors for your analysis. And this is exactly the same thing for the debt ratio. So you look at the global analysis, you look at the dividend triangle in terms of trends, you look at the business model, and then you look at the ratios, and eventually it's like putting the final nail on the coffin for your analysis. You really pinpoint the problems and then you can identify what is going wrong. But if you just
Mhm.
look and try to trade on good quick ratio or good current ratio or bad ones, it's not going to give you the full story. So you need more information. You know, you need more meat around your bone before you take a final decision around that stock.
So, at this point, BCE's dividend safety is far from guaranteed. But what other problems does this pose?
Well, right now the solution at this point is to reduce unnecessary expenses, right? You want to free up some cash flow for future business activities. In this specific case, Bell announced the acquisition of assets in the U.S. At the end of 2024, which will require even more cash flow. So you really
Mhm.
need to look at your business operation and find ways to cut down expenses. One of them that they did already was to lay off people. So you want to get a leaner business model. You want to be more effective and efficient. So cutting off some jobs, like reorganizing your structure, being more profitable is a pretty good solution. Another one that you could do is obviously cutting down the dividend. I know that I sound like a dad at a family meeting saying, well, you know what, kids, I just got a salary cut of 20%. So sacrifices must be made. I mean, it probably means no vacation this year. It probably means
Hmm.
that we're going to cut on the restaurant or something else. Well, Bell is has to face those decisions. So will they cut their dividend or not? I don't know. I'm not in management place, but this like the math don't lie. They will
Hmm.
need to find ways to improve their cash flow because that situation for the next 5 years is not sustainable. So either they will magically generate more revenue growth and more cash flow from that, or they will more realistically cut down on their expenses to get those ratios in a more positive light.
All right. So, on a more positive note, we find Broadcom ticker is AVGO because, I mean, doesn't make sense, this ticker, right? Why does it use that, Mike?
There is actually a reason why the thicker is outgoing the company's Broadcom. It's a result of one of their many acquisitions. So when they
Right.
made a merger with Avgo, they kept the ticker. So that's the explanation. It's actually a good segue into why they're using debts. Is their business model is all about growing through acquisitions. It's a tech company. They're making multiple things. We're not going to go into all the details, but for one, they're making RF filters, so that improve the connection in your smartphone. So you can imagine how popular that is. They're also offering a lot of products because they're in the semiconductor business. They're also offering a lot of products to help computers compute faster. So for AI, it's perfect as well. And this is also being driven from the latest like growth from Avgo is also all those products around the AI wave. So on top of acquisition, they are also a heavily capital intensive company. They spend
Hmm.
tons of money into R&D. Why? Well, it's quite simple. If you operate a technology company, you're always one innovation away to get destroyed. We can think about how BlackBerry got destroyed by the iPhone, for example. Well, same
Hmm.
thing for Broadcom. If any companies are able to offer better RF filters or better other chips that they're making, well, then boom, they're going to see their revenue going down. So just to give you an idea, on average over the past 5 years, we're talking about around 16 to 17% of their revenue going into R&Ds. So for 2024, that was 9 billion on a 52 billion revenue. So that's a lot of money going into R&Ds. That's a lot of money to acquire new acquisition, to acquire new businesses and integrate them into the business. And of course, they cannot finance all of this with just free cash flow. They will require debt.
Okay, so what does the current AVGO debt situation tell you, and why does it seem sustainable?
So that's very interesting because if you take a step back and look at the dividend triangle, you will realize that the company is showing double digit revenue and earnings per share growth over the past 5 years. In other words, the global perspective is they're using debt to grow. So that's the narrative, right? I just explained like, oh yeah, this company is like investing in R&Ds. They come up with new technologies, they're making acquisitions. So that's all qualitative information. It's just the
Hmm.
analysis of like, what's my story behind Broadcom. Then you need to back your story with numbers, and then you look at the dividend triangle and it looks amazing. You look at the current and quick ratios, they're all around 1. So telling you again that they have short-term cash to pay their short-term obligations, not a problem there. And then you can see that there's no problem if you go into more debt when you generate more cash flow. So when cash flow is positive, revenue is positive, earnings per share is positive, that's not really a problem to get into more debt. At
Hmm.
DSR, we also offer the graph of the past 10 years for the long-term debt. So there are about like 10 graphs for each companies on the stock card. One of them is showing you how the long-term debt evolves. So that's not a ratio, but that's a clear indication of how the company is using debt to finance their growth. When you look at this debt ratio from Broadcom, you will see that the debt will grow typically. I mean, we were below 20 billion in 2016, and now we're above 60 billion. So it seems a bit steep, but we see that it grows through plateaus. So for a while, the company will pay down its debt or maintain it for a while, and then they're going to increase it massively. But most of the time it's because they either like have a massive R&D project, research and development project, or they will make an acquisition. But right after they jump the debt, they usually are in a good position to pay it down at for or at least a portion of it. So you see it goes up and then it's starting to go down, then it goes up again because they see another opportunity. Of course, over the long run, it's not sustainable. They cannot eventually go to 100 billion of debt and then 200 billion of debt and then like $1 trillion of debt. They
Hmm.
need to keep that into control. But as long as they're able to grow their cash flow, earnings, and revenue, it's not necessarily an alarming situation.
And what would make you change your mind or become a red flag?
Well, there you go. If I see a slowdown in the dividend triangle, well, then I'm going to start asking myself, should I sell this stock or not? And full
Hmm.
disclaimer, I deeply regret not having Broadcom in my portfolio because I've been talking about Broadcom since 2016. So it's been almost 10 years now that I am regretting this choice. But anyways, one of the rare companies that I don't have in my portfolio, and I'm a big fan of it. But if revenue starts to stagnate and then you see earnings like stagnating or going down, well, then that's a bad sign for the debt situation because it tells me that the company business model, which was getting to more debt to spend that into R&Ds, into acquisition that will generate more cash flow, has stopped.
Hmm.
So you have to be a bit careful though for Broadcom EPS because the EPS will be affected by amortization, which is not a cash item related to their acquisition business model. So you just have to like be careful about that. But overall, looking at revenue, cash flow from operation, and then earnings per share. If they're slowing down, I'm going to rapidly do exactly the same thing that I did with Bell is to look into the financial statements, look at the debt ratio and see what's going on there. Probably that I'm going to have some numbers telling me that the company is not what it used to be. And then the red flags are just going to pile up one after the other. So as you can see, it's not that simple.
Hmm. So, to end this episode, I'd like you to summarize the key points for analyzing debt to listeners.
Yes. So, first point, probably one of the most important, debt is good. Debt is a leverage. And when companies are using debt the right way, they're going to grow faster, generate more wealth, generate more value for shareholders, and then you're going to be happier, right? Um, to make sure that everything is under control, the first red flag that you can look at are the credit ratings. It's going to be a good indicator to tell you if the business is doing well or not. You must add context around it. To add more context and help you out, you need a global analysis first. So, using the dividend triangle is a pretty good way. There are other ways as well, but the point is to have a global understanding of the business before you do a deep dive into debt ratios. You have
Hmm.
liquidity ratios and solvency ratios will tell you how the balance sheet is strong enough for short-term obligations and the strength of the balance sheet as a whole. Those numbers will confirm or infirm your global analysis. One ratio cannot tell you everything like any other ratios. You must add color. It must be used to add colors to your analysis, and context must apply. Finally, it's really important to understand the business model and understand why the company is using debt. If they're using debt to pay a dividend, it's probably a bad sign. If they're using debt to grow by acquisition, to invest in R&Ds, and in other words, to generate additional growth and value for shareholders, well, then it's probably a good business model. So you need the combination of looking at global metrics, and then you can dig into ratios to make sure that you pinpoint any problems there and you make a better decision as an investor.
Well, thanks a lot, Mike, for helping us understand debt with concrete examples. Listeners, build your buy list based only on our best stock ideas. Grab your free copy of the Top Stocks booklet at thedividendguyblog.com/topstocks. For the show notes and related content, visit thedividendguyblog.com/212. Next week, talking about leverage, we will have a guest on the show, Liquid. We have welcomed him about 2 years ago when he was about to reach fire, which he did. So we will do a follow up. So hit the subscribe button underneath our podcast logo now to avoid missing it. Until then, stay invested.
Hey, fellow investors, it's Mike here. I hope that you have enjoyed this episode. Please note that the Dividend Guy blog podcast is at no time issuing buy or sell recommendation. Please do your own due diligence as this podcast is recorded for information and hopefully fun purposes only. Make your research, make sure you do your stuff. We're not responsible for your losses or your profit after listening to this episode. And until next one, stay invested.